Hello, Oracles. Well, what can we expect from the market this week, the week of December 23rd, 2024? Well, it's going to be kind of a split week, seeing as we are going to have the market closed on Christmas Day, which is going to be Wednesday. So that's kind of an in between day there. It's kind of screwing up the week, but realistically, the next 2 weeks are going to be very similar with the two holidays falling on the Wednesday, splitting the week up. Plus, there's a lot of Wall Streeters that are on vacation right now, so there's not going to be a lot of action. Historically, it's a lower volume couple of weeks that we're about to go through, and this is where you get that Santa Claus rally. Typically, with the lower volume weeks, there's a lot of people who are done selling. Wall Street's done selling what they want to do. They've rebalanced their portfolios, and then it's kind of retail investors. And now you're kind of at the whim of, hey, people are excited about spending and buying gifts and things like that. And so people with that spending spirit typically come in and buy a little bit in the market and end up pushing up stock prices. So the question is going to be, are we going to get that again? Of course, last week after Jerome Powell came out, gave us the 25 basis point cut, and then kind of gave us some verbiage in his meeting, kind of indicating that we're going to be getting fewer rate cuts next year, the market did not like that. We obviously saw a sell-off for the next 2 days, and then we kind of bounced back a little bit on Friday. We discussed that last week in the live stream where we weren't sure if Friday was going to be red or if it was going to fall and then bounce back up and then kind of close the day stronger. So we ended up getting that green day on Friday. So now it looks like we could potentially be getting maybe a little bit of green over the next couple of weeks. Now, of course, that's just my guess. I have no idea what truly is going to happen, but I think that's probably what's going to play out over the next couple of weeks. And then once we get into the new year, we're going to have Wall Streeters coming back, and then they're going to take a reassessment of what had transpired over the next couple of weeks and say, hey, where do we think we're going to be going from here? What do the jobs market look like? What do we think is going to happen with Trump? We've got earnings coming up in a couple of weeks. So that's what Wall Street is going to be looking at the beginning of January. So for this week coming up, probably going to be a little bit green, lower volume as expected. But of course, lower volume could also mean that we swing down in a stronger manner, because typically when you have lower volume, you get bigger moves one way or the other. So looking at stocks like Tesla in particular, we saw that pull down massively. It was all the way up to 490, then pulled all the way down to 415. Now on Friday, it started the day low, ran back up again. We were looking at possibly testing that 450 level, and then it sold off into close. So we may see some volatility movements like that over the next couple of weeks, where you see some big intraday movements, but then at the end of the day, we end up green. So just something to pay attention to. There's no real economic data that we're going to be getting out over the next week. We're not going to have any earnings over the next week. So realistically, there's nothing that's going to fundamentally move the market one way or another. It's strictly going to be sentiment and whatever retail buyers want to buy. Because again, there's not really a lot of Wall Streeters out there right now that are going to be making any moves in the market this week. Now, tomorrow I will be doing a stock gap analysis on Tesla again and Nvidia. I'm going to be doing it on Tesla just because with this big drawdown, we're going to take a look and see what gaps got filled and then kind of assess from there. And it's just good to have it on your radar as a possibility as what could happen. Because again, we talk about it all the time. Hey, Tesla's running up strong. It feels like it's unstoppable. And then something happens in the macro environment and we pull down significantly. So many times, and I've seen it happen many, many times before, people just kind of think that, hey, it's invincible. It's never going to get pulled down. It's stronger than the macro environment. It never, ever is. I don't care what company you are talking about. There is no company that is going to be individually stronger than the macro environment. And Tesla is going to move stronger in one way or the other based upon macro environment news. Hence the reason why we saw a 9% pull down last Thursday after we got the FOMC meeting. So this is just one of those things that you really need to pay attention to, because pulling down from 490 to 415 in basically 2 days is a massive move. So to think that we could not pull down to fill a 218 gap is really unrealistic, and you guys really need to make sure that you at least have it on your radar as a possibility. For whatever reason you're looking at this as an investor, whether you're a long-term investor and you maybe don't have the conviction in the stock and you're wondering why it's pulling down so far. Maybe you're looking to get a buying opportunity. Maybe you're a swing trader and you want to buy it and you're looking to swing and maybe you want to sell up here and then buy down low. Maybe you play options on it. Whatever it is, it's important to understand why these gaps exist and where they are, just so you can understand what's going on if you are paying attention to the stock on a daily basis. But again, we'll get into that tomorrow in tomorrow's video. And for me and what I'm doing with my portfolio, I'm currently just going to let it ride this week. I did add significantly last week during the dip. I bought to basically kind of just broaden out. And for anyone who's unfamiliar with how I run my portfolio, it's basically a modified dollar cost averaging portfolio where I have ultra yield ETFs up here for strictly income generation, high yield income ETFs that are going to also be for income generation, but these are ones that I will be holding longer term. And then I've got my REITs, BDCs, and MLPs in here, also going to be long-term income generation. Then I've got my long-term growth ETFs. These are going to be ETFs that are both going to grow in equity appreciation and income over time. And then the stocks. And so what ends up happening here is this column here tells me where to add. So as stocks pull down, I have a threshold that I want. So for instance, Pepsi and all of the stocks in this category here, I want to have at $575. So I basically run them to equal weight. But, as they run over time, some run faster than others. And then when you get a pullback, some pull back further than others. So when it pulls back, if it pulls back below this threshold, I add that amount. Now, typically, I don't add anything unless my cash threshold has been met. My cash threshold right now is 11.5%. However, with this buying opportunity, I had a feeling it was going to be short-lived and I wanted to take advantage of it. So I did spend more cash than I had available to bring me down to 9.4% cash. But my strategy going forward from here is after the first of the year, I will be selling out SPYD and I'm selling out Devo. I think they're both good ETFs, but I have so many other ones in here. And for instance, Devo, I had it because it was a dividend oriented ETF that was driving in some pretty good income, has a yield over here at about 4.5%, has fantastic total returns. However, if I'm going to be looking for income generation, I have ones that are going to be bringing in significantly higher yields. 10+% over here. So it's missing out on that. And then when we look at equity appreciation, it's no different than a lot of the ones that are down here in these ETFs. Then if I'm looking at dividend growth, it doesn't have the same dividend growth as most of these down here, like a DGRO or an SCHD. So it's kind of a bridge between these two. So if you wanted to buy one ETF instead of buying multiples, you certainly could, but the expense ratio is a 0.56%. So for me, that's on the higher side, where I can get a JEPI or a JEPQ at 0.35%, and then I can have an SCHD at a 0.06%. So it's a lot less expensive to own these two individually, and I'm going to get better high income from these, and I'm going to get better dividend growth from these down here. So to me, it didn't make any sense to hold on to it, so I'm selling this one off. SPYD is also a dividend-driven income ETF, which has a pretty decent yield at 4.23%. And this one does have REITs in it where SCHD does not, but I already do own some REITs. So if I've already got the REITs that I want to own individually, then I look at the yield over here, and yes, the yield is a bit higher than SCHD, but it's not that much higher, and it doesn't have the same dividend growth as SCHD, so it doesn't make any sense for me to have SPYD either. So I will be selling out both of those. That there will free up a significant amount of cash to get me back to that 11.5% cash threshold. Then I can continue adding to more of my positions. I'm also going to be looking to consolidate some other positions down here. My whole situation down here is going to be, hey, if I have all of these ETFs, are any of these stocks individually in the top 10 of any of these ETFs? If so, what is that percentage? Do I really need to own it individually, or can I just let the ETF run with it? Or is it just that good of a stock where I do actually want to own some extra of it? Like Visa, I definitely want to own some extra of that. Broadcom, probably want to own extra of that. The Magnificent Seven, I think I want to own all of those, even though they are in VU. So for me, I'm just going to be going through and I'm going to individually take stock by stock, ETF by ETF, and try to trim this down. And I have a little strategy, so I kind of set those levels where you saw that $575. And every time I get through and I hit all of those levels on every single category, and then I move it to the next step. So currently right now, I'm on level 2, step 4. So once I finish all of that, I'm going to move to step 5. And I just have those different categories and I just keep bumping it up. So as I consolidate, after each step, I want to consolidate one more position and trim that off until I get down to what I feel comfortable with. And as I trim, it just means I'm going to be adding more money to the more higher conviction plays that I have. Because as Warren Buffett says, why would you add any money to your 20th position when you could just put that in your top 5 positions? So that's kind of what I'm doing right now, is figuring out, all right, well, which ones aren't doing the best for me? Where can I get a better bang for my buck? And I'll shift that money into those positions. That's all I'm doing right here. And again, a lot of times some people just do ETFs. So I'm kind of going to consolidate it down to maybe mostly ETFs, and I'll have my other reasonings behind other things like the ultra yield income. And again, over time, those will get thinned out as well, and I'll eliminate all of those. But this is just how I run my, and I kind of intentionally over diversified so I could really see what I had out there, what was the best plays for me individually. Now I can trim those off and figure it out what is best for me and really kind of whittle that down. So it was an intentional move for myself to over diversify, to now be able to get that cut down into the positions that I truly want to have for the long term. It's one of those things where I always look at long term in my life and everything else. I've done it with video games, and that's kind of where I got the idea. I'm playing fantasy role playing video games, and I'm like, well, what do I want my end game character to be? What skills do I want him to have? What abilities do I want him to have? What kind of wealth do I want my character in the game to have? What do I want to have him be at end game? And I was like, well, why don't I do that for myself? So I'm going to look at what I want for end game, and my end game for myself is going to have enough wealth to have financial freedom for myself, but also have it growing in dividends over time. Some people say ETFs are the better way to go because if you pass something to your next generation, you don't want them to be burdened. If it's something that they don't enjoy doing, you don't want them to be burdened by having to go through and figure out what other companies are in there. And you just have those ETFs and let the ETFs and expense ratios and the management teams do what they need to do. And then your future generations can just go off of that. And that's a great idea. And so I'm kind of toying between that. I want to make sure that my son, whether he wants to enjoy it or not, and he's dual majoring in law and accounting. So perhaps with the accounting side of things, it will be something he enjoys. But I want to be able to leave that to him. So end game for me, when I'm passing on, I want to be able to have him have that nest egg of financial freedom. So he doesn't have to work if he doesn't want to. But I also want to give him that knowledge of how to take all of these dividends and everything that I have built for him to the next generations as well and continue that snowball down the road multiple generations, because we have seen how the snowball works when it comes to dividends and compound interest. If we can do that within one lifetime, imagine what you could do over multiple generations. That's why there's some people out there who have massive generational wealth, because they have been doing that. I want to teach my son to do the same thing, and I'm starting that snowball now. So that's what I want to have at the end game for me. I'm not looking at an end game for myself where it's like, hey, I've won the game. It's, hey, I want to be able to be at a position in the game to give my son a much stronger foundation to take his end game to the next level and teach him all of those things. And so that's kind of where I'm building right now. Is that's what I'm setting my portfolio up, is what stocks and ETFs do I want to have at end game? Knowing full well that things could change over time. I'm always going to have to pay attention to that. But what is the ultimate goal at my end game, and what am I going to be building along the way for that? So let me know in the comments below what you guys have for your end game, and let me know what you guys celebrate for holidays that are out there. I know you guys are from all over the world. I personally do celebrate Christmas, so you guys can let me know in the comments below, and happy holidays to all of you. Thank you so much for watching. I appreciate all of your support. Have a great one.